that?
Because ये तो सबको पता ही है कि आज presentation होना था ना बाकी के.
Yes, ma'am. Everybody knew. I even sent a schedule last night.
ठीक है. So I think Harshita, you can time Ashok and we can get started. And Ashok, तुम अपने बाकी team members तो तुम्हारे हट ही गए ना, तो Harshita just note down the team members इसके, ठीक है?
Yes, ma'am. Ashok, you are from group number 6, right?
Yes, ma'am.
Okay, great. So who are the 2 members who are present here from your team?
Me, Ashok, and the Nitesh Dagar.
Okay.
So where's Nitesh?
Ma'am, he's suffering from dengue. So
अच्छा, so Harshita, he is the only one who's presenting. Nitesh को डेंगू हो गया है, तो वो hospital में है ना?
Yes, ma'am. He did texted us.
ठीक है.
Okay, Ashok. Then you can start, and I'll just start timing you.
Okay, ma'am. Hello, ma'am. Screen is visible.
Yes, it's.
Now it is.
So in this whole project, we are making a project on the electric vehicle. So this is our tag Alto Energy, and this is our tagline. We believe in sustainable energy. So we are making the electrical vehicle scooter like this. So like we are saying YOLO in our comparison like that. So that's what was our purpose for making this project. And these are the more feature. Actually, we are for the purpose of this, there are simultaneously there are a lot more research going on, and there is a need of electric vehicles and for the cost friendly and the efficiently. So our main purpose was to make them cost friendly as well, because it's been seen as that it might be expensive for the some, so they might not access. So it was our little bit purpose make them cost friendly. So other thing we add in this was key customer can book their vehicle at comfort at their home at all. So actually we will deliver. If we are having just one factory at one position, then we would deliver through our agency to their home. And other thing which we added here was the customer can customize vehicles according to their desire. What colors they need, what is design, what the extra step or interior, not interior in that case, but the stuff they want to edit in the scooter design. So it was one of those things which we work out. And so this is the imaginary thing we picked up. So our startup was established in 2017. It's automobile industry's technical startup focusing on sustainable and eco-friendly vehicles. Customer can customize, I said, customize everything they want on website itself. So actually we are just like the very renowned and modernized companies. We are making the websites, so this customer has to go there and register, and then we or the backend team will contact them, what kind of product they are looking for and what kind of things they need. So this is the process. And another thing which is really helping to them, we are also providing the maintenance facility across the country throughout the website, which is monitored by the Microsoft. So actually we are setting up a center. This is facilitating all the things here to maintenance facility. If there's something went wrong with the delivery and some damage happened in the scooter, and technically then our team could help. So our factory is located in the Delhi NCR, or we deliver vehicles across the country. Our head office in the Delhi, and R&D center is located in Bangalore. So as you know, in the electric vehicle there is need of more and more research, because then someone can sustain in the market. And so I think this column has gone. So net worth was around 50 crore. It was, I think it has, when I converted it into the PDF, it went up. So it is our balance sheet, ma'am. So we have a earlier we started with the user base. So when we thought of such a product, then we thought our product, earlier this company was selling the automobile industry. So we just shipped our industry to electric vehicles. So we had some sort of some sort of user base. So we come with that and cash, office asset, factory asset, and patents, because R&D in the electric vehicles that need of patents. So this is our total asset. Liabilities are here, ma'am. Factories, employees, and so this is, and it was of 2018 and it is of 2019, ma'am. So similar to that, and this is of 2020, and this is a comparison between 2018 and 10. So in the next slide there is a graph, so I can present better. So this is graph, ma'am. To in the you can see the where is a peak and where is dip in that sense. So later on, here is the liabilities comparison in 3 years, 2018, 2019, and 2020. So it is here, and similarly liabilities are present in the graph as plots, so someone easily can interpret and analyze them. Okay, ma'am. So later it comes to the case flow 2018 20. So what are the operational expenses and the depreciation, to what case, what assets value are we are getting low, and like that user based practices and net flow the case. So in all these year we're getting minus. Initially startup needs some sort of push up for their market. So these are the our income statement. So we are getting invested, we are getting money from the investment, we had some sort of user base, OPs assets, we have a factory assets, so we have a large factory assets. So we are some of the parts we are just selling, and so we might get some amount from there to a selling, and the total revenue is this case out. So obviously there are machinery work is going there, so maintenance is required, OPs team also required to case to give money and salary, office maintenance, advertisement, R&D, and the call center and total expenses. This call center is for two purposes. One is for the to deal with the incoming customer, and the another one for the to dealing with the once the customer has got the vehicles, and if they are facing any issue, technical issue, and that income statement. So income statement is this. So this is the comparison between 3 years, 2018, 2019, and 2020. So uh, for the expenses, how we went through the various parts. So there are three: Ether Energy, Revolt Motor, and Tesla are the very brilliant name in the industry of automobiles, specifically in the electric vehicles. So we went through some through their websites, and we couldn't get more data on that side, specifically on data income and outcome, but which were typically we can get from other side as well, because
only 30 seconds are left.
Okay, so cost of pieces are simply startups, so employee salary are deciding current market. So these are the very simple wherein we can get the data, and these are the projects. And so for upcoming 2 years and next 3 years, projection of revenue next 5 years. So that's similar to what, and projection of revenue is also plotted in this graph. And later how we calculated the projection of revenue. So project income minus project expenses or estimated sale average price of each scooter. So these were the method by which we calculated the project revenue, and later was the survivor revenue. This
Ashok, time is up.
okay, ma'am. So my slide is also over, ma'am. Thanks.
Okay.
Thanks, ma'am.
Team number 9, Pankaj Jet, Surendra, Rahul, anybody present? All right, team number 10, Rishabh Jogni, Ronit, Ujjwal. Team number 13, Abhishek Tiwari, Monu Meena, Hardeep, Rudransh, anyone there? Team number 14, Vyam Gupta, Vijay Kumar. Okay, team number 15, Vaibhav Gupta, Asim, Sukhdev, Shubham, Tanmay. Ma'am, nobody else is present today.
ठीक है, तो हर्षिता, ये काम्या तुम्हारा हो चुका है ना प्रेजेंटेशन? Kamya, we can't hear you. Satvik, what about you?
मैम मैं ग्रुप 10 से हूँ, मुझे अभी प्रेजेंट करना है.
Presentation is done.
So where are your group members, Satvik?
मैम एक्चुअली आई थिंक वो चारों ऑडिट कर रहे हैं, सो दे डिडंट कम.
चारों ऑडिट कर रहे हैं. दे डू नो कि ऑडिट क्राइटेरिया 60% ना, तो उनको 0 मिलेगा इसमें बिकॉज दे आर नॉट प्रेजेंट. ठीक है, ठीक है. सात्विक, तो तुम प्रेजेंट कर दो. एंड काम्या, व्हाट अबाउट यू?
Ma'am, my presentation was done.
ठीक है, योर्स इज डन. ठीक है, तो हर्षिता, आप बाकी जितने भी ग्रुप्स हैं ना जो नहीं आए उनको 0 दे दो और सात्विक का प्रेजेंटेशन ले लो. एंड उसमें भी अगेन आई थिंक ही इज द ओनली वन हु इज वर्कड, और सात्विक, हैव द अदर्स आल्सो वर्कड?
नो मैम, आई एम द ओनली वन.
ठीक है, सो बाकी सब जितने उसके ग्रुप में सबको 0 और सात्विक का प्रेजेंटेशन ले लेते हैं हम लोग. सात्विक, तुम अपना दे दो.
यस.
Satvik, you can start. I'll start timing you.
ओके मैम. One second, ma'am. I think I'm not able to share. Just 1 second.
Sure, take your time.
Is my screen visible?
Not yet.
Okay.
Satvik, in case something is wrong with your sharing, you can email it to Harshita ma'am and she can share it. Don't waste time.
Yeah, ma'am.
Satvik, have you emailed?
I've mailed to Harshita, ma'am.
Yeah, I still haven't received your email, Satvik. Satvik, I have dropped my email ID in the text box. Please confirm that you are mailing it on the same.
Yeah, ma'am, I've sent it now.
Okay, let me
Harshita,
check.
Before I
ma'am.
forget, just note down two more things. एक
Yes,
तो
ma'am.
आज ईमेल जो भेजोगी ना, मतलब टॉक टू मी आफ्टर द क्लास ऑल्सो, जो ईमेल भेजोगी उसमें लिख देना कि ऑडिट पास इज 60 फॉर दिस कोर्स.
Okay,
And
ma'am.
the other thing is that for anyone who does not take the major exam, चाहे वो ऑडिट कर रहे हो चाहे जो हो, उनको सीधे F ग्रेड दिया जाएगा, बिकॉज अगर मेजर नहीं दिया है आपने तो F ग्रेड दिया जाता है. ठीक है?
ठीक है, मैम. I'll do that.
ठीक है, हम लोग डिस्कस भी कर लेंगे. हाँ.
Sure, ma'am. Satvik, I still haven't received your email. Can you please check your outbox? Satvik,
Yes, ma'am.
can you please confirm? Can you please check your outbox? I still haven't received your email.
Ma'am, my outbox is empty.
Okay, fine. I have received it now. Great. So you just need me to share the PPT, right?
Right, ma'am, the PPT and the Excel.
Okay, both. Okay, just allow me a minute to download it.
Right, ma'am.
My screen is visible, right, Satvik?
Yes, ma'am.
Okay, can you see the PPT?
It hasn't opened yet.
Okay, let me share it again, please.
Yeah, I can see it now, ma'am.
Great. Fine, okay. So let's just put it on.
So should I start?
Oh, you can start. Yeah.
Right, ma'am. So our startup is called as silverstone.com, and we are India's only platform for selling traditional jewelry online. Next slide. Right, so this is group 19, and so I'm Satvik, and I think, so no, this is group 10, and I'm Satvik, and I'm the only group member. Next slide. So what do? So we are basically an online platform for local jewelry store owners to sell their pieces on the internet. So we basically connect jewelers and customers. So we help jewelers by helping them expand their reach. So these jewelers normally what they do is that they only sell to like about 50 or 100 customers that live around the area. But because of silverstone.com, now they can basically sell to anyone in India. And we help customers to access the widest variety of designs possible, right? Because now they can basically select from thousands or tens of thousands of designs from our website. Next slide. Right, so let's look at the market now. So India is actually the third largest jewelry market in the world, and it's growing at 8%. But this market is actually moving from traditional stores towards more online mediums. So this means that millions of Indian traditional jewelers are actually going to need a way to transform. And that's where we come in. Next slide. So this is our competition. Carrot Lane, Bluestone, PCJ, and Jewelshuk. So there are a few websites that are already doing this. But if you look at these companies, they are actually run by some of the largest brands in the country. For example, Carrot Lane is actually a partnership with Tanishq. Bluestone is owned by Tata, and Jewelshuk is owned by Geetanjali. Right. Next slide. right? So it's almost impossible for a small traditional jeweler to sell online, right? And that's where we come in. So next slide. Right, so this is our model in action. So basically, a customer would visit the website, they would choose a design that they like, then we would connect the customer to the store that owns that place. Then we would basically be responsible for packaging and delivery of the piece, and then we would collect maybe a certain percentage of the transaction as commission. So this is the end of presentation. Now we can look at the financials in the Excel. Right, so yeah, so this is the balance sheet. So we've divided liabilities into two parts, the total liabilities and owner's equity. So the sum comes out to be 1.62 crores. That's the total liabilities and equity. In assets also, we've divided into two parts. We have the current assets and the non-current assets. The current assets, this works out to be, I think, 1.19 crores, and the non-current assets works out to be 43.2 lakhs. So the total assets also comes out to be, I think this is, yeah, 1.62 crores, right? So same as the total liabilities. Next, we can look at the P&L. Right, so this is the income statement. So here, the revenue was actually 13.5 crores, and so which is actually very high for a startup, but that's because we are selling jewelry. The actual profit is only 2. Uh, yeah, it's is only around 2 crores, right? So then from the gross profit, we can then remove the marketing expenses, delivery costs, website and app maintenance costs, SG&A. Then we get the EBITDA. We remove depreciation to get EBIT. Then we remove the interest expenses and taxes. Taxes are marked as zero because there's a government scheme. So therefore, the net income, I think this works out to be 1.4 crores. Now we can look at the schedules. Right, so we can look at three schedules: cost of goods sold schedule, the cost of production schedule, and the inventory schedule. So we have actually made this projection for the next 3 years, 2022, 2023, and 2024. Now we can look at the cash flow statement. So this is the cash flow statement. So I think in the end, the net change is actually around 1.3 crores. And since last year we had the beginning cash was around 50 lakhs, so finally the ending cash would be around 1.8 crores. Finally, we can look at the survival revenue calculation. Right, so this is the survival revenue calculation for the next 3 years, and here, right, so here we have calculated survival revenue for the next 3 years. Below this, we have also mentioned the actual projected revenues, and we see that in 2022, the actual revenue is actually higher than the survival revenue. And the gap is small for 2022, but this gap would only increase over time. Right, so that was the end of our presentation.
Okay, you are well within time.
Okay.
ओके सात्विक, तुम आर क्यों बोल रहे हो जब तुमने अकेले किया है सब कुछ? तो
हाँ मैम।
अच्छा, हाँ, इज देयर एनीवन एल्स लेफ्ट? ठीक है, तो हर्षिता, व्हाट वी विल डू इज गिव एवरीवन एल्स अ 0, बट सिंस अभी क्लास चल रहा है, सो वी विल जस्ट हैंग अराउंड टिल द क्लास इज ऑन and wait for any other group that wants to come and make a presentation. Otherwise उसके बाद हम लोग सीधे 0 दे देंगे सबको, ठीक है?
Okay, ma'am. Fine.
ठीक है, and Ashok, Kamya and Satvik, since it is the time for presentations, so we are not doing anything else in the class today, but would you like to discuss something or any questions that you have?
Ma'am,
हाँ बोलो अशोक.
do term paper in the group as well as it was made earlier.
हाँ अगर तुम अकेले करना चाहते हो तो अकेले भी कर सकते हो अशोक या ग्रुप में. सो अभी हर्षिता विल सेंड आउट अ डिटेल्ड ईमेल रिगार्डिंग ऑल ऑफ दिस. ओके and you can do it in the group or you can do it alone also, whatever you are deciding to do. It's
No,
okay.
Group will be same, ma'am.
हाँ of course. अभी लास्ट मिनट पे तुम लोग ग्रुप कैसे चेंज करोगे?
But lot of more students are withdrawing or auditing the course, or neither more of interested in doing those sort of things.
So you can regroup in case you want, but whatever you do, please inform us in advance.
Okay, ma'am. We will inform Ashita ma'am, take permission of her.
And Harshita,
Yes, ma'am.
just discuss all of these aspects after the class. Acha, abhi what should we do? Should we wait for any other group members in case they can come in, or should we continue with the class? What does the class feel? Ashok, Kamya and Satvik?
Ma'am, as you feel like, I just have a doubt. When can we expect this presentation marks?
Bus after today, give us some few days, then we can expect the marks.
Okay, ma'am.
Okay. तो हर्षिता क्या किया जाए?
Ma'am, I think we can move on with the syllabus. The rest of the students doesn't look like they are gonna join now.
Okay. So what were we doing in the last class? I don't remember. I think it started with valuation. Did we start with valuation?
Yes, ma'am. We finished the PPT actually.
Just a second. No, just a second. I'm going to share my screen and then we'll just see. So Harshita, we have to send out a very detailed email regarding a number of things. I'm sure you're noting down some of those aspects as well, but just discuss it with me before you send it out, huh?
Sure, ma'am.
Okay, so which PPT had we done, Harshita?
Ma'am, that was valuation PPT which we covered. It was of 8 pages. Let me just check the name of the PPT.
Okay, okay. Because I have a lot of stuff over here. I don't know what all we had done. And Harshita, just check once whether the material and all is there available online.
Okay, ma'am, will do.
पहले इनका ये बता दो. Okay, I can see some PPTs here. So let me see if they were.
Ma'am, introduction to valuation was the PPT which we covered last.
Acha, was the material basically?
Yes, ma'am.
Right, the material.
Yes.
So
Yes,
what are the PPTs? Have we done the PPTs?
Ma'am, yes, valuation methods PPT was done.
Okay.
And then this was the last material which we covered.
Okay, so then I think we have to do developing projected financial statements. Okay, fine. So this is the second one. Chapter 9, yeah. Okay, so students, in the last class before the presentations, we had started off with valuation, and I believe that we had done some presentations which have already been uploaded on your platform. And then we had also done one case study where we saw that Jim, being a micropub owner, what should he think of when an investor comes around and asks him that I would like to invest X amount in your company and I would like to get equity for that. So then we decided that the past really doesn't matter. And it is basically a future valuation that makes all the impact on your company's value. Okay, so we have already done how we develop the projected financial statements, but let's do that again in the context of valuation. So through another caselet. So, but before I begin, are there any doubts, any questions that the class has, Ashok, Kamya or Satvik, that you have from valuation, whatever we had covered so far, before I move on, or is it okay? I can move on. Batao?
It's okay, ma'am.
Okay.
Yes.
Okay. Fine. Okay, fine, fine. So let's assume that PDC company's cash flow statement projections for the 4 months, that is April, May, June and July, were on track, and it is now August 1st. A potential venture investor is considering buying some of the venture's equity. So now we have a venture investor who's interested in buying some equity. We need to get a good approximation of PDC's value to facilitate the negotiation of investment terms. Harshita, I hope that this is visible clearly. I have
Yes,
increased
ma'am.
the... Okay, great. So we begin by projecting PDC's financial statements for an explicit 4-year period plus a stepping stone year, where year t is equal to 5, starting from 81Y0 and ending on 731Y5, where Y0 and Y5 simply indicate year 0 and year 5. Recall that we introduced the percent of sales method for projecting financial statements for the game toy company. If you remember, we had done one caselet on game toy where we looked at the percent of sales method. Although the valuation technique does not depend on it, we follow a similar process for the PDC company. First, we formulate top line sales forecast. PDC estimates that fiscal year sales ending July 31st, year 1 will be 1.656 million. Sales are expected to grow by 20.8% in year 2, 40% in year 3, 6% in year 4, and continue at a 6% growth through the foreseeable future. So table 1 shows these top line sales expected growth rates and the resulting sales levels in each forecast year. Second, we must forecast relationships between individual expense or cost accounts and sales. When a venture has little operating history, past relationships may not reflect expected future relationships. In such instances, the entrepreneur can supplement subjective judgments by considering related competitor or industry financial relationships. We adopt the following percent of sales relationships in our projections. Okay, so you have also seen the subjective judgments. Harshita, I'm sure we have done the equities and PPT in detail also, right? Where we looked
Yes,
at all the
ma'am.
qualitative methods.
Yes, ma'am.
Okay,
Yes.
great, great. So here in the expense account, we can see that the COGS have been 70% of sales. The wages and commissions have been 19.167% of sales, and rent, miscellaneous and insurance expenses have been 6.75%. Furthermore, our projections incorporate annual depreciation expenses of 10% of the prior year's year-end net property, plant and equipment. Recall that net PP&E is gross PP&E less accumulated depreciation. In addition, net PP&E for forecasting purposes is projected to be 3.4% of sales. The interest rate on interest-bearing debt is 10% of the outstanding debt at the end of the prior year. Because no interest-bearing debt is expected to be issued until the end of year 4, there will be no interest expenses until year 5. So interest is paid on the outstanding debt balance at the end of the prior year. Now table 1 shows the forecasted income statements for the next 5 years. In year 1, sales are forecasted at 1.656 million. COGS is determined as 1.159200 million, which is nothing but the sales into 70%. And wages and commissions of 317,400 are projected at 19.167% of year 1 sales. So basically here we have the projected income statements which you've just done in your presentations as well. Just let me bring the size down. Okay, for the different years. Okay, so here you can see sales based on the growth rates and the income statements. Sales minus COGS, minus wages and commissions, minus rent, miscellaneous and insurance expenses, minus depreciation gave us our operating profit, less interest gave us our EBT, less taxes gave us our EAT or net income. And from this, when we take out the dividends, which in this case is 0, then we get our retained earnings or the profit that has been plowed back. So rent, miscellaneous and insurance of 111,780 are 6.75% of year 1 sales. Net PP&E is 57,960 at the end of year 0. Thus depreciation is projected to be 5,796 for year 1. There is no interest expense because there is no outstanding interest bearing debt. Taxes of 18,547 are 30% of the 61,824 of earnings before taxes. No cash dividends are paid out in these projections. In the percent of sales method for projecting balance sheets, asset accounts, excluding surplus cash, are expressed as a percent of sales. Non-interest bearing current liability accounts expected to move with sales are also expressed as a percent of sales. Recall that we discussed this approach when making balance sheet projections for the game toy company as well. After examining the limited historical information for PDC and making other adjustments, we use the following balance sheet account percent of sales. So again, for the asset liability accounts, we again take it as a percent of sales. So we have required cash as 1.5% of sales, accounts receivables at 2.778%, inventory at 5%, prepaid insurance at 0.139%, net property, plant and equipment at 3.4%, the accounts payable at 2.5%, and the accrued wages and commissions of 0.694%. So table 2 based on these projections presents the resulting balance sheets. For end of year 1, required cash is projected to be 24,840, which is 656,000 into 0.0150. We apply the appropriate of sales to each of the other asset accounts with the exception of surplus cash. Similarly, for the liability accounts, we project payables of 41,400 and accrued wages and commissions of 11,500. For now, long-term debt is not expected to automatically move with sales. Recall our discussion that owner's equity comprises the investment of owners plus the accumulated amount of earnings retained by the venture. Assuming that there are no new equity investments or withdrawals, the owner's equity account should change only by the amount of additional earnings retained in the venture. Net income is forecasted at $43,277 for year 1. With no dividends being paid, the increase in retained earnings will be by that amount. By adding the 43,277 to the previous owner's equity account balance of 187,957 at the end of year 0, we arrive at an end of year 1 amount of $231,234. Okay, so this is the projections of the balance sheets. Again, everything except for the surplus cash is taken as a percentage of sales. Okay, and similarly it goes for current liabilities and long-term liabilities as well. So with these quantities in place, we can complete the projected balance sheets. Recall that we use an additional funds needed AFN plug to make the sum of the total liabilities and equity equal to the venture's total assets. Here we plug surplus cash. That is, we solve for the amount of surplus cash that makes the balance sheet balance. A negative surplus cash account value means that we need additional financing, which we've already seen in our cash budget calculations also. A positive account value indicates the amount of excess or surplus cash above the cash amount needed for day-to-day operations that could be paid out in dividends. To use a surplus cash account as a balancing plug at end of year 1, we total PDC's liabilities and equity accounts to reach a total amount of 284134 at end of year 1. We then subtract from that number the amounts in each projected asset account. The difference is surplus cash. Cash not absolutely needed at the time to execute the business plan. So the sum of required cash, accounts receivables, merchandise inventory, prepaid insurance and net property, plant and equipment is 212,244. When we subtract this from 284,134, comes out to be $71,890, which would be the amount entered or plugged into the surplus cash account to make the balance sheet balance. That is total assets equal total liabilities and equity. Notice that the surplus cash on the balance sheet is basically an inventory of accumulated surplus cash built over the forecast period. So naturally, if your assets are less than your liabilities, then that means that there is some surplus cash which is lying there. At end of year 4, we projected that PDC would issue long-term debt in the amount of 226,642.62 at a 10% interest rate. As indicated above, Interest is paid on the amount of debt outstanding at the end of the prior year. The long-term debt account rises to 240,241.18 for an additional increase of $13,598.56 at end of year 5. Always remember, students, that your interest will only be charged on the outstanding principal amount. Recall from our financial statement projections for the game toy company that we were able to construct a projected statement of cash flows from projected income statement and balance sheet. Changes in cash are based on the net impact from cash flows from operating activities. Table 3 presents the projected statements of cash flows for each of the next 5 years for the PDC company. Note that the ending cash balances on the projected statements of cash flow equal the sum of the required and surplus cash account balances on the related year-end balance sheet. So here you have the projected statements of cash flows also with retained surplus cash. So we start with the net income and then we adjust the net income for different cash flows. So of course we add back depreciation. We subtract any change in prepaid insurance, basically any value that is coming down in case of assets, and we add any increase in current liabilities. So plus add any increase in accrued liabilities minus change in inventory, because you can see inventory going down, plus changes in accounts payable, that is your current liabilities again, minus any increase in your accounts receivables or debtors. Basically any increase in current assets would mean locking in of funds and hence outflow, and any increase in current liabilities would mean someone else indirectly financing us, and that would indicate an inflow. So total adjustments are these, and the net cash flow from operating activities comes out to be 13,387 and so on for the next years. Cash flow from investing activities, we have capital expenditure which is happening every year, so there's a negative cash flow or a cash outflow. And then we have cash flows from financing activities where we don't have any equity or dividends or debt issues for the first 3 years, but then we have raised debt in the last couple of years. Okay. So the net change in cash and cash equivalents would be the addition of all of this, and the beginning cash balance has been given to us. So the ending cash balance is nothing but the net positive change in cash and cash equivalents plus the beginning cash balance. Okay, so this is how they have calculated the cash flow statement. Yes, does anyone have a doubt or a question? Okay. So while projected financial statements you've been presenting in this part of your business plan presentations also, while it can be prepared by hand, it is much more efficient to prepare specific interactive spreadsheet models. Having the ability to change a variable such as a sales forecast and have the model produce a new income statement, balance sheet, and statement of cash flows can provide insights for planning the venture's future and assessing the impact of changes on the venture's equity value. So we have a lot of readily available, freely available Excel templates where you can just put in all of these numbers and they can do a ready-made calculation for you and give it. And that gives you a real-time flexibility that in case your investors say that what if costs go up to this, what would be the resultant net profit and so on. So you can immediately use that in real time. So it's always a good idea to have a spreadsheet with the calculations built in so that you can look at different scenarios. Okay. So this presents this PPT, but any doubts, any questions so far? Ashok, Kamya and Satvik, तीन ही लोग हैं. Or should I move on? Anyone? कोई कुछ बोल ही नहीं रहा. ठीक है.
Yes, ma'am.
Okay, fine. Okay, now we see how the equity valuation pie starts splitting up, okay, with different stages of your investments. So we begin our treatment of VCSCs or venture capital shortcut methods with the simplest of shortcuts, a procedure sometimes called the venture capital method. Very, very popular way to value startups, very popular. The basic venture capital method estimates a venture's value by projecting only a terminal flow to investors at the exit event, say in 4 or 5 years. So basically the idea is to get an exit value, that in 5 years, what do you think the value of the venture would be? Modifications of this basic VCSC will allow us to consider additional rounds and incentive compensation. We will conclude our discussion. This is not conjured, I'm sorry. We will conclude our discussion of VCSCs by extending the basic method to reintroduce intermediate cash flows and incorporate scenario extensions. As an example, we will present a 3-scenario venture valuation with intermediate cash flows. So the basic VCSC approach is simple. We should have the cash investment today. We should have the cash returns at a future exit time. And we should be able to discount this entire return flow back at the venture investor's target return. Divide today's cash investment by the venture's post-money value, and you get the venture ownership to be sold in order to expect to provide the venture investors target returns. Divide today's cash investment by the venture's post-money present value, and you get the percent ownership to be sold in order to expect to provide the venture investors target return. An example of this simple procedure will help clarify the structure. So let us see how this is done. Now, Linda Chen founded a new venture last year with $10,000 in equity capital, for which she received 200,000 or 2 million shares of common stock. So she had 2 million shares. The venture is now moving into its startup stage and needs an additional 1 million to carry out the business plan. If Linda had 1 million to invest, she could retain 100% ownership of the venture. However, because Linda does not have additional equity funds to invest, she is negotiating with a venture investor who's willing to invest 1 million for an ownership position in the firm in the form of newly issued shares of common stock. The investor and the founder agree that the horizon or time to exit for the investment should be 5 years. The investor expects a 50% compound annual rate of return for the entire 5 years. We need to value the venture based on a 5-year exit and determine how many shares to issue to the investor for the 1 million. So basically what we need is the future value and the time to exit. Excuse me. So looking ahead 5 years, we can say that the successful venture is expected to produce 1 million per year in income at that time. We also know that a similar venture recently sold shares to the public for 20 million and that its last 12 months of income was 2 million. So P was 20 million and E was 2 million. We infer from this that the going price per dollar of income in this technology sector is $10. That is, the P ratio is 10. And estimate the venture's exit value 5 years from now. So multiplying $10 per dollar of income by the 1 million of projected 5th year income gives a venture exit value of $10 million. So this is dollars. Discounting the 10 million exit value by 50% per year for 5 years gives a present value of $1316872 or 10 million divided by 1.5 to the power 5. Okay, so it's basically just discounting that value. So here you can see figure 1 depicts the 10 million future value exit pie. Just a second, students, just a second. Okay, sorry about that. Now, if you see the figure 1, it depicts the 10 million future value exit pie over here, as well as the 1316872 present value of the exit pie over here. So we can work the VC valuations using either form of the exit pie. For initial purposes, we will begin with the present value exit pie, which is consistent with applying the discounted cash flow valuation methods in chapter 10, which we did, whereby we discount further cash flow back to the present. Okay. So it is this. Either you can take the present value and multiply it to get the future value, or you can discount the future value to get the present value. To apply the VC shortcut method, one must first calculate the percent ownership to be sold and then calculate the shares necessary to achieve that ownership. Equations 1 and 2 implement the VC method. Using I for the investment, E5 for the venture's earnings or net income in year 5, PE ratio for the comparable price per dollar of earnings or net income, M for existing shares, N for new shares to be issued, and R for the expected or demanded rate of return, we have the following calculations. Acquired percentage of ownership is nothing but I upon P by E into E5 divided by 1 plus R to the power 5, which is what we did. Okay. And acquired percent of final ownership is I divided by P by E into E5 divided by 1 plus R to the power 5. Okay. So this is nothing but when we substitute the values, we get 75.9375%. Okay. And when we have to look at the shares to be issued, then N is equal to M, that is the existing number of shares, into the acquired percentage, which is 75.9375, divided by 1 minus the acquired percentage, which is basically 0.240625. And this gives us the total number of shares to be issued at 6.311688 million. So in equation 1, we have an investment numerator of 1 million. The denominator gives the venture's 10 million future value, that is 1 million in net income times the PE multiple of 10 discounted back to the present using 1.5 to the power 5. The result is 1 million divided by 1.316872 million, which equals to 75.9375%. The equity ownership percentage that must be given to the $1 million investor to get the deal done. Equation 2 calculates the number of shares to be issued to the new investor so that he can achieve his stated expected compound annual rate of return of 50%. So the new shares to be issued can be found by dividing 1518750 by 0.240625, which equals 6311688 shares. The total number of shares that will be outstanding after the investment would naturally be this plus 2 million original shares. So it will be 8311688 shares. So dividing 6311688 by 8311688 gives the 75.9375% ownership acquired by the new investor. Likewise, the founder will own 2 million divided by 8.311688 million, or 24.065% of the venture after the new 1 million investment. Okay, so these two equations will tell you exactly what would be the percentage of ownership. Okay, and this equation 2 will tell you the number of shares to be issued. So very simple formulae given to understand valuation and the ownership dilution. Although it is common practice to calibrate investment decisions using present values, ventures often require more than one round of financing and also may have an incentive ownership round. Because these additional financing rounds are likely to occur sometime in the future up to the venture exit, venture capital shortcut methods sometimes work directly with future exit values. Instead of venture of capital, their shortcut. I'm sorry, this has been mistyped somewhere, so just forget this. I will correct it. Okay. We can easily change the reference time frame from present values, that is 1 million investment and 1316872 present venture value, to year 5 values, that is 7593750 future value of the $1 million investment and the 10 million future venture value. Either way, we'll get the same answer. Okay. So whether you look at it from the future value perspective or you discount the future value to today's value, you will get the same percentage ownership. Equation 3's numerator would be 7593750, which is equal to 1 million inflated by 1.5 to the power 5. The denominator is the same 10 million exit value. Yes.
Ma'am, we
Yes,
lost your
Harshita?
voice. We lost your voice in between, ma'am.
Is it audible now?
Yes, ma'am. Now it's audible.
Okay. Okay. So do you want me to repeat something or do you think it's okay? How much time
Ma'am, just the
could you
first.
not hear me?
Ma'am, for just 2 minutes. For you can just start with the first line again.
Acha, okay, fine. So here the equation 3 is numerator from here.
Yes, ma'am. You can start from.
Okay, fine. So equation 3's numerator would be $7593750, which is equal to 1 million inflated by 1.5 to the power 5. The denominator is the same 10 million exit value, that is 1 million net income times the PE of 10 as before. Dividing the future value of the investment by the future exit value also suggests granting a 75.9375% ownership position to the new investor. Although the result is the same whether the calculations take place in present or future values, it is important always to compare present values to present values or future values to future values. This is important for calculating PVs with PVs and FVs with FVs. But be careful in comparing PVs with PVs and FVs with FVs. Now, panel A of figure 11.2 shows that founder Linda Chen could retain 100% ownership if she could make the 1 million investment herself. At exit, she then would own all of the 10 million future value. However, because this is not feasible, panel B illustrates what would happen to Linda's ownership position, assuming a new 1 million investment needed to carry out the business plan, in which the investor expects a 50% compound annual rate of return. After the 1 million capital infusion, the founder would have only a 0.240625 or 24% ownership. In other words, the ownership percentage for the founder drops from 100% ownership to just 24% ownership. Okay, so this is after the first round of financing, Linda's ownership has fallen from 100% to 24.0625%. So founder percent between financing and exit was only 24.0625%, and investor percent between financing and exit is 75.9375%. With our equations, it is easy to calculate deal parameters commonly used in discussing venture investments. So if we have to calculate the issue share price, it's nothing but the amount of investment divided by the number of shares. So that gives us 0.15843622 per share, or around 15 or 16 cents. Venture investors sometimes refer to pre-money and post-money valuations. The pre-money valuation is the value of the existing venture and its business plan without the proceeds from the contemplated new equity issue. And the post-money valuation is the pre-money valuation plus the proceeds from the contemplated new equity issue. So pre-money present valuation is nothing but the 2 million shares into the share price per share that we have arrived at, that is $316,872. And the post-money present valuation is multiplying the same value per share by the actual outstanding shares after the investment round, and that gives us $1,316,872. Put differently, the pre-money present valuation of $316,872 plus the proceeds of 1 million results in a post-monetary present valuation of $1,316,872. It is important to recognize that both the pre-money and the post-money present valuations depends on executing the business plan and its necessary 1 million investment. Okay. So pre-money, agar future valuation nikalna hai, so we can just multiply the whole thing with 1.5 to the power 5, which is the target rate of return. So you will get pre-money future valuation at 2.406250 million, and the post-money future valuation would be $10 million, which is what we have arrived at anyways. So the pre-money future valuation of 2406250 plus the future value of the 1 million investments of 9593750 results in a post-money future valuation of $10 million. Both the present and the future value versions of the VCSCs ignore all potential or actual intermediate cash flows to or from existing or future investors. So we are only looking at these cash flows. We are not worried about any intermediate cash flows. The associated surplus cash penalty is partially diminished by providing financing in sequences of rounds called staged financing. Before we modify our example to include 2 rounds of financing, we first digress to consider the quick method we have used for calculating an exit value and how it relates to the terminal value found by discounting perpetual cash flow. So this is 10 million. Okay. So now, so far we have only seen 1 round of financing, but what happens in case we have multiple rounds of financing? So let's see. First, we look at the earning multipliers and discounted dividends approach that is applied to get the final valuation. So the application of an earnings multiplier to projected earnings to get a projected terminal value is intuitive. After all, P divided by E into E is nothing but P. So that is very intuitive. Okay. Just a second, let me check this also. This is the essence of the earnings multiple conversion of earnings into terminal price. We take a price earnings ratio multiple, apply to earnings and get price. This method doesn't get interesting until we give the price earnings ratio and the earnings a separate existence and forget their rather direct relationship displayed here. For example, suppose we take a price earnings ratio from another current venture's prices and earnings when selling shares to the public and apply that ratio to projected earnings for our venture 5 years in the future. The resulting estimated terminal value is no longer identical to the price as in the equation above. It is an estimated future price. Okay. So here we have PE of other current firms into the E of venture in year 5 gives us the price for that year 5. Okay. A direct application of a price earnings ratio to venture earnings is sometimes known as a direct comparison method. We are really just comparing other firms' characteristics to a venture's expected characteristics to get a glimpse at possible values for the venture. This type of comparison is similar to examining dollars per square foot to estimate comparable values for real estate. For our current purpose of relating earnings-oriented and dividends-oriented terminal value methods, we focus on variations of the earnings multiplier. We get an idea of what's coming by rewriting the multiplier equation as this. So this is nothing but a reversal of the PE ratio. It's called the earnings multiple, or in method form, it is also called the direct capitalization method. Nothing but the reversal of PE ratio. This is sometimes referred to as a direct capitalization method. Displaying the multiplier relationship this way hints that we may be doing something like discounting a perpetuity of E at a rate EP. EP looks like a return on an investment of P. It is like an accounting rate of return, except that we have used price instead of book value per share. So returning to our previous valuation example, we used a projected earnings in year 5 of $1 million and a comparable venture PE multiple of 10. The year 5 value was calibrated as in the equation to be PE of other firms into E of venture in year 5, and that is typically 10 into 1 million, which gave us the 10 million values. To reinterpret this valuation under the direct capitalization method, we note that a PE ratio of 10 is basically a capitalization rate of 0.1. So we just divide the venture's earnings in year 5 by 0.1 to get the valuation of the venture at $10 million. To examine more carefully the relationship between price ratios and discounted perpetuities suggested by the direct capitalization method, we can derive a representation for PE and EP when price equals the present value of future dividends. Denoting per share values of earnings, dividends, and prices as E, D, and P respectively, we know from the terminal value calculation that the time 5 value and assumed price of a growing perpetuity of dividends starting with dividend of D6 is given as P5 is equal to D6 divided by R minus G, where R is the discount rate and the dividends grow at rate G. In a constant growth, a smooth growth mode, dividends are equal to the earnings multiplied by a constant payout ratio, that is DE. The payout ratio equals 1 minus the plowback ratio of B. B is nothing but the earnings minus dividends divided by E. The plowback ratio is also called the retention ratio. It means just the retention. How much of the earnings are we taking back into the business? Okay. So this is the basic PE assumption. I don't think you need to worry too much about the way we have gotten here, because most of you have not done any basic course in finance. So just remember that we use the PE ratio in terms of direct capitalization, in case of direct comparison, and we use the EP ratio in terms of direct capitalization method. Okay, so this is just the working of that ratio. Okay. Now we come to adjusting the VCSCs for multiple rounds. But before that, are there any doubts, any questions from Kamya, Satvik or Ashok? Is it okay? Harshita, just do a check that we have done all the rest of the material. Na? Matlab just confirm that once, okay? Because none of these three people were available in the last classes, so I can't ask them. But I don't want any material to be left out.
Sure, ma'am.
I think we have covered, right?
Yes, ma'am. In between, we have covered in the classes, but I'll still check again if there is any file left.
ठीक है. Okay, thanks. Okay. Now, all of you know that venture financing is usually done in rounds. If additional rounds of financing are needed to achieve the year 5 projected earnings in our current example, the accompanying dilution must be considered in the current round. Failure to do so will result in the investors not receiving an adequate number of shares to ensure the necessary percent ownership at the time of exit. Suppose the first round investor believes that Linda Chen's venture cannot reach the E5 projection without an additional 1 million infusion at the end of year 3 from a second round investor expecting a 25% compound annual rate of return on the money contributed at that time. In essence, the first round investor is suggesting that he doesn't really buy the original business plan's optimism about getting to the 10 million exit, having spent only as much as that plan allowed. He is arguing that there's another 1 million of expenses to be covered to get to that same 10 million exit. By the exit, the 10 million pie will therefore have to be split amongst three parties, that is the founders, the first round investors and the second round investors. Because the first and second round investors will pay share prices that allow for their 50% and 25% expected returns, all of the loss in ownership resulting from the second round will be borne by the founder. So let's see how this is done. As before, we calculate the acquired percent of the same exit or terminal value for the second round investor to be 1 million into 1.25 to the power 2. Okay, this is for the second round investor divided by the 10 million exit value. That gives us 1562500 divided by 10 million or 15.625%. The first round's acquired percent remains at 75.9375%. This leaves only 8.4375% for the existing 2 million shares. At the terminal period, the total number of shares outstanding will therefore be 2 million divided by 0.084375. That is 23 million shares, 23,703,704 shares. We must therefore issue 0.759375 into this 23 million, that is 18 million shares in round 1, and 0.15625 into 23,703,704, that is 3,703,704 shares in round 2. Note that at the first round, the initial percent ownership sold to the round 1 investor is much higher than the 75.9375% ultimate ownership. It is 18 million divided by 20 million, that is 90%. So between the first and second round, his ownership will be 90%. A total of 84.375%, that is 1 minus 0.15625 of the investor ownership fraction will be maintained through the subsequent financing. The reasoning behind this example easily extends to multiple subsequent rounds. So all we need to do now for the second round acquired is look at the investment value, that is 1 million, into 1 plus R, that is 25% to the power 2 because it's being invested for 2 years, divided by the exit value, that is 10 million, which gives us 15.625%. Okay. So the first round acquired percentage is 75.9375. The founder's remaining percent is now just 8.4375%. Okay. So the total shares after financing now are 23 million. So 23.703704 million. Okay. So now you can see the impact on the shares and the share price in the first round and second round. Shares issued have been 0.759375 into 23 million, 23.703704 million, that's 18 million. The share price has been 1 million divided by 18 million, that is 0.0555556, basically 6 cents per share. The pre-money valuation has been 6 cents into 2 million shares that were there in the beginning, that's $111,111. And the post-money valuation has been this share value into 20 million shares, that is $1.111 million. So the founders percent between the first and second round has been 10%, and the first round investors percent between the first and second rounds has been 90%. In the second round, we have issued these many shares, that is 15.625% of the 23 million shares, that is 3.703 million shares. The share price has been 1 million divided by these number of shares, so that is nearly 27 cents per share. So the pre-money valuation now is 27 cents into 20 million shares, that is 5.4 million, and the post-money valuation is 27 cents into 23 million shares, which is 6.4 million. So the founders percent between the second round and exit is now just 8.4375%. The first round investors percent between second round and exit is 75.9375%, and the second round investors percent between the second round and exit is 15.625%. So panel C of figure 3 depicts this further, the sharing of the exit value pie among the founder, the first round investor and the second round investor. Notice that the first round investor retains his 75.9375% ownership dilution associated with the second round investor. Unfortunately, the founder Linda Chen suffers the loss in ownership position from 24.0625% down to 8.4375%, or a difference of 15.625%, which goes to the second round investor. So the only person whose share in the pie keeps reducing is the founder, and you can see that her ownership is now reduced to just 8.4375%. Now, all of you must have heard that to attract good employees in the startup, you also give employee stock option plans or a share in the ownership to these employees as well. And that is called the incentive ownership round. So as an incentive to attract good managerial talent. Okay. So let's look at another round of investments where we are basically giving shares to potential employees. What happens then? Again, whatever percentage we are giving to employees, it will eat into the ownership percent that is remaining with the owner. For most early stage ventures, there are at least two strong motives for having an equity component in employee compensation. The usual reason is that the expected deferred and tax preferred compensation allows the venture to pay a lower current compensation, thereby lowering the current need for external financing. The potentially more significant reason for the equity component is the substantial impact it can have in motivating employees towards a founder's and venture investors' shared goal of a high value for the company's equity. Almost without exception, professional venture investors demand that some equity or deferred equity compensation be formally anticipated and structured into any valuation. Some of the shares allocated to equity-based incentive compensation will be for current employees and some will be for those added as the venture grows. In any case, the portion of final or exit year value to be distributed as incentive compensation must be considered in valuing each round. As you might guess, this portion of ownership really comes from the entrepreneurs and founders' stakes. That is, given a fixed exit value and fixed demanded returns for venture investors, the only place from which it can come is the dilution of existing ownership. Perhaps our example venture has agreed to set aside 6% of exit time ownership for use as incentive compensation. The shares will be distributed through a stock option plan and are expected to generate 200,000 in exercise proceeds when the options are exercised at the end of year 5. Importantly, we assume that the use of the 200,000 in proceeds has already been included in the projected financial statements so that we do not need to add it to the 10 million exit valuation. So the valuation we seek is post money and post exercise. So for simplicity, we will treat the 6% issue as occurring in year 5. In many respects, this issue is just another financing round. Proceeding as we did before, the relevant calculations are, now the founders' remaining percent will be just 2.4375%. So total shares after financing and incentive options are 2 million divided by this 0.024375 or 82 million shares. And similarly, we can do this entire exercise for the first round, then the second round and the incentive ownership round. So as you can see, at each round, the share price would be different and it would keep on eating into the founder's ownership percentage. Okay. Now we can see numerically how the outside investors are protected against the 6% incentive ownership dilution, the burden of which is borne entirely by the founders. Anticipation of the 6% dilution causes the first round and second round investors' necessary initial percent ownership to rise from 90% to 96.89%. Simultaneously, the founders' ownership percent after round 1 declines from 10 to 3.11%. When we look at the difference between a single round and 2 rounds with incentive ownership, it is startling that non-founder shares issued rise from 6.311 million for 1 million a round to 21,703,704 for 1 million rounds to around 80 million for 2 rounds and 6% incentive ownership. So you can see how the ownership or the number of shares is increasing exponentially when you compare it with the ownership rounds. So panel investors illustrates what happens to the ownership of the investors and the founder after the accounting for the incentive ownership round. Notice that the buy-in ownership positions of the first round investor and the second round investor remained at their initial level of 75.9375% and 6% incentive ownership round was borne by the venture's founder. The result is that the founder only has 2.437% ownership position in the exit valuation pie. The price per share in the first 1 million round drops from a little less than 16 cents per share with 1 round to less than 6 cents per share with 2 rounds to less than 2 cents per share with 2 rounds and the 6% incentive ownership. Such is the impact of dilution. Every entrepreneur should understand the principles and mechanics of dilution before negotiating any type of external financing. So every owner, every entrepreneur has to be very mindful of the fact that it is his ownership that will get diluted tremendously. And he or she may not even have a dominant shareholding left after multiple rounds of financing. Now, adjusting VCSCs for payments to senior security holders. If you recall, students, we were also discussing that there are a lot of securities that carry preferential rights with them, that carry warrants with them, that carry convertible securities with them. So you have to look at what is their payment when you are exiting. Okay, and you have to take care of their preferential rights before that. So in many cases, a venture before the exit period will issue debt and other alternative securities, that is convertible debt or participating preferred equity, having senior claims to the venture's wealth. If you think of a venture's exit value as a pie, the purchasers of these securities must be served their dessert before the founders and common equity investors get theirs. It is important that the valuation shortcuts and other methods appropriately carve senior claims out of the pie prior to dividing the remainder among the venture's common or ordinary shareholders. Traditional valuation methods, including the equity method of valuation, calculate a dividend or equity VCF as the cash remaining after all debt obligations are paid. This is evident from the statement of cash flows and the direct calculation of equity VCF. Debt holders have been paid before we get to equity VCF. The capitalized value or terminal value of equity VCF is therefore free and clear of debt obligations. When using VCSEs, we need a similar understanding of who has been paid. Our current example calibrates the exit value by multiplying earnings by 10 to get the exit valuation. Because we don't have a formal set of financial projections, it is difficult to know how much, if any, of the 10 million other security holders will eat before the equity investors. Of course, we only want the value of the equity investors portion. Do we have to set any part of the 10 million aside to satisfy debt holders? No. Earnings are after interest, but not after principal. While it is not obvious from the simple application of an equity multiplier that the 10 million is free and clear of debt obligations, perpetuity interpretations of the multipliers make it clear. A growing venture targeting a fixed debt to value ratio will issue more debt each period than it retires. The amount of outstanding debt grows at the same rate as everything else in the venture. So the entire 10 million belongs to the venture's equity investors. No net debt deductions other than those already in the calculation of earnings are necessary. Okay, so you have to be very careful to check whether there are any debt payments that have to be made, whether there are any preference rights that have to be given, any money that has to be given to anyone before we look at the pie left for the ordinary shareholders. What about other types of equity or hybrid securities that can be converted into equity? While we reserve the details of how senior equity securities are structured, modifying the VCSE to recognize senior equity claims on the venture's exit value is quite simple. As an example, we consider equity that has a preferred payment senior to other equity holder payments and is not included in the venture's projected earnings or net income. For clarity, suppose that our example venture issues a security that, in addition to granting a one-share equity claim, promises that purchaser a full return of the purchase price before the common investors get a cent. That is, if the security is purchased for say $1, the investor would be entitled to a return of the $1 first and then entitled to a one-share claim on what's left. One can see that the $1 is not anywhere in the earning or equity VCF. Consequently, the 10 million exit value would be partially claimed by all those that hold this senior security. Issuing these securities makes the proceed a deduction from the exit value before we divide the remainder. Suppose in the first round in our current venture example involved such securities. We must subtract the 1 million proceeds of the first round from the terminal value before dividing up the remainder. We could redo all of the foregoing analysis with an exit value of 9 million instead of 10 million. Mechanically, this gets the job done, but lacks some realism. Granting first round senior claims on the exit value can and probably will change second round negotiations. Consequently, any suggestion that the fix of granting 1 million seniority to first round investors is to cut the common equity claim to 9 million and proceed as before is potentially misleading. When second round investors see that first round investors have been given a senior 1 million claim on exit value, would they not ask for the same or demand higher returns if not given equal status? Reducing the exit value to 9 million while keeping future discount rates the same sets up all of the necessary mathematical translations but misses the point. Granting seniority shifts risk from those that get seniority to those that grant it. Okay. So there are two important questions to ask when dealing with senior claims on the exit pie. First, who has already eaten? And second, are the remaining claimants who is scheduled to eat before we do. You must make sure senior claims are properly staked in your analysis. A more subtle additional point is that seniority in the current or a subsequent round changes negotiations throughout because it's going to affect everyone else. Recognize the value claimed by senior investors and remember that granting seniority complicates future fundraising. Okay, so this was a case study where you saw how the ventures valuation pie gets split amongst different rounds of investors, and the only person whose total ownership gets diluted is the founder through multiple rounds. We also saw how you value the company in each multiple round, how you look at the number of shares to be issued, what is a percentage of ownership to be diluted, and we also looked at share price per share after each subsequent round. So this caselet had all of that inbuilt. So now there should be no issues whenever you're looking at valuation. You can actually take care of all of these aspects. Yes, Harshita?
Ma'am, 2 minutes left.
Okay, thanks. So students, I'll wrap up here today. And Harshita, you and Samriddhi, just check whether we have completed everything in this valuation or not. Because now after this chapter, the only thing that is left is that one module on compliance.
Yes, ma'am, I
Okay.
will do that.
So before tomorrow's class, we need to figure that out. And Harshita, Abhi, I have a class committee meeting. I'm already late for that, so I'm just rushing into that. I'll ping you once it's over, and then maybe
Okay.
you and Samriddhi can together give me a call so that we can then discuss the email that has to go out. Okay.
All right, ma'am, we'll do
Okay.
that.
So Ashok and Kamya and Satvik, any doubts, any questions so far?
No, ma'am.
No, ma'am, not at all. But
Okay.
I have one question. But it's okay if you're
Yes.
getting late for the meeting. We'll discuss tomorrow.
Okay, fine. Is it a short question or does it require a long answer?
A long one, ma'am.
Acha, ठीक है. So just remember to ask it tomorrow in the class, okay?
Yeah, sure, ma'am.
Okay, great. Thank you so much, Harshita. Thank you so much, everyone. And Harshita, I'll ping you after the meeting, okay?
Yes, ma'am. Thank you, ma'am.
Thanks so much.
Thank you, ma'am.
Thank you.
Thanks.